Most people have certain problem with the connection. Uh, Prepare to pass ACCA for F6 UK taxation. Today, the motive of the activity is to discuss the mock examination with you people. The questions of this mock paper has already been transferred to you people, for which the discussion has to be taken place today. Okay, guys, can you hear me? 3 hours and 15 minutes are actually given to you people in your exam, for which 3 sections are to be attempted. Section A, Section B, and Section C. The Section A and B are MCQ based sections, while Section C is over constructed form questions. Scheme. What amount of class 4 NIC will William pay for the tax year 16-17? Keep one thing in mind, class 4 NIC has to be computed over tax adjusted trading profit. So whatsoever the tax adjusted trading profit is, William will have to compute class 4 NIC. For the tax year 16-17, his profit is £82,700. Let me show you the rates again. So here class 4 NIC rates are given to you people in front of you. For calculating the class 4 NIC, we'll have to check whether the profit is like 8060 or less than this, on which no NIC has to be paid. If your earning is in between 8061 to 43,000, then rate of 9% has to be applied, and all those earnings on which are going to be like over and above £43,000, rate of 2% has to be applied. So I'll be calculating this MCQ with a few people. As the earning figure is £82,700, so over first 8060, no rate has to be applied. Then from 8061 to 43,000, rate of 9% has to be applied. From 8061 till 43,000, it actually means that this lot contains 34940. So over 3490 pounds, 9% rate has to be applied. The result of it is 3145. And the remaining amount out of 82,700, 8060 does not catch any kind of rate. Next 34940 has got the rate of 9%. In short, total amount except for 43,000 will be taxed at the rate of 2%, and 2% rate will become 794 pounds. And this is how the total NIC will become 3145 plus 794. The total figure will become 3939. So the option C is correct for MCQ number 1. As far as personal pension was mentioned in the question, it was just to confuse the students, because personal pension has to do nothing with tax adjusted trading profit. Now moving towards the second MCQ, which is, you are a trainee chartered certified accountant and your firm has a client who has refused to disclose a chargeable gain to HMRC. From an ethical viewpoint, which of the following actions could be expected from your firm? Number 1, reporting under the money laundering regulations, advising the client to make disclosures, third, informing HMRC of the non-disclosure, and then warning the client that your firm will be reporting the non-disclosure. Keep one thing in mind: being a certified chartered accountant, being a trainee accountant, basically you will have to show your honesty towards HMRC, plus confidentiality aspects of client has to be maintained as well. So that means that if in case you are going to report under the money laundering regulations, that could be perfectly fine, because if the problem is suspecting to be a large one, then it has to be reported to money laundering reporting officers. Second one is advising the client to make the disclosure. That's obviously the main emphasizing point, that being a trainee accountant, you will have to advise your client not to take certain action. Rather, you will have to put a stress on your client to make a disclosure, and you will have to make him understand what consequences could be there if in case disclosure is not made. So first and second points are relatively fine. Then the third one is informing HMRC of the non-disclosure. It is never be the case that the trainee accountant will be telling HMRC of the non-disclosure of the client, because the trainee accountant will have to maintain the confidentiality aspects of client as well. So you may report HMRC, or I should say that you will have to report HMRC that you have stopped acting on the behalf of this client if in case client doesn't listen to you. If in case client does not make a disclosure, then of course you would stop acting for him, and that you have stopped providing him the services. This is something which you have to tell to HMRC, but you need not to tell the reason for which you have stopped working for that client. And of course you cannot even threat your client. No kind of threat could be provided to client that you are going to report the non-disclosure to HMRC. This is not going to be the case. So first and second point are correct. So the correct option is B. Then coming to the third MCQ, Martin is a self-employed and for the year ended 5th April 2007. Keep one thing in mind: Martin is an individual, so tax year is important. His trading profit was 1,09,400. During the tax year 16-17, Martin made a gift-aid donation of 800 gross to national charity. What amount of personal allowance will Martin be entitled for the tax year? So class, keep one thing in mind: whenever your ANI is found to be more than 1 lakh pound, your personal allowance will be reduced. So what ANI is? ANI stands for adjusted net income, which means the total income. Could you see one thing, that he has only one source of income, which is 1,09,400, and that could I so that it's like his total income as well. Less interest paid in order to see what net income is. Martin has not got any kind of qualifying loan on which he would be paying interest. So net income is 1,09,400 minus gifted donation gross if he had paid any, or minus gifted personal pension scheme if in case he has paid any such kind. So personal pension scheme has not been paid, but he has paid gifted donation of 800 gross. If in case net amount would have been given in the question, we first had to like gross it up by multiplying the donation figure with 80 over 100%. In this case, grossing up had to be done first, but as already a gross income a gross donation has been given to you people in your question, so it is going to be taken as it is. 1,09,400 is the net income less gifted donation gross. ANI will become 1,08,600, and as you could see, this is like more than 1 lakh pound. Whenever ANI is found to be more than 1 lakh, we'll have to see what an excess figure is. Excess figure is 8,600, and the half of this figure is going to affect your personal loss. Half of this figure is 4,300, and your personal allowance is 11,000, out of which 4,300 is going to be deducted. So your revised personal allowance will be 6,700 pounds. So which option is correct? That's one against option B. Moving towards the fourth MCQ of section A. For the year ended 31st March 2017, Harlow Limited made a trading loss of 1,80,000. Harlow Limited has owned 100% of the ordinary share capital of Shallow Limited since it began trading on 1st of July. So I can say that Harlow Limited has got 100% shareholding in Shallow Limited. That means these are the group members. They are associated 51% related group members. Plus they can also exchange losses with each other, because as far as group relief is concerned, 75-75 structure has to be met. And as we could see that Harlow has got 100% shareholding in Shallow, that means 75% shareholding is existing over this level. Plus they have got a direct shareholding in Shallow, so indirect rule has not to be applied. So we can say that 75-75 group relief will also be made available in this case. Okay, continue with the question. For the year ended 30th June, Shallow Limited made a trading loss of 224,000. Could you see that for Harlow Limited, the year ends over 31st March, and for the Shallow Limited, their trading profit is 224,000, and this is for the year ended 30th June. Harlow had a trading loss and they have a trading profit. Neither company has made any other profits or losses, so there is no other income or expense in the whole question. What is the maximum amount of group relief which Shallow can claim from Harlow Limited in respect of trading loss of 180 for the year ended 31st March? So as you could see that Harlow Limited has made accounts from April 16 to March 17. That means they have made accounts for 12 months, and whatsoever the loss incurred in these dates are supposed to be adjusted against the taxable total profits of the corresponding period of claimant company. Whereas Shallow Limited has made accounts from July 2016 to June 2017. We'll have to see this thing as these two companies have got different accounting period. So how many months are supposed to be like common to each other? That means what is the corresponding, the matching period, overlapping period? As we could easily see that Harlow Limited has a starting date of 1st April 2016, and Shallow Limited accounting period is going to be starting from 1st July 2016. Out of the two starting dates, we are supposed to take the latest date for starting purposes, 1st April and 1st July. On the later basis, Shallow Limited is basically going to start making their accounts. And as far as both ending dates are concerned, I'll have to see what an earlier ending date is. Earliest ending date is 31st of March 2017. So people, this is actually the period which is like common to each other from 1st July to 31st March, and this is how 9 months are common to each other. So I'll have to portion this thing. If Hello Limited has a trading loss of £1,80,000, this is for a year, then what has to be loss? What has to be the case for 9 months period? For 9 months period, loss figure is said to be £1,35,000. As far as Shallow Limited is concerned, Shallow Limited taxable total profit is £2,24,000, which is meant for a year. But once again, as 9 months are common to Hello Limited, so corresponding period adjustment has to be applied. 9 months taxable total profit is £168,000, which shows that Hello Limited is like ready to surrender a loss of £135,000, but Shallow Limited cannot claim over and above £168,000. They can have a capacity to claim maximum up to 168, but Hello Limited cannot surrender more than 135. So out of this, I can easily say that Hello Limited figure 135,000 is the maximum figure of loss which could be surrendered in a group. So option D is correct. Then coming to 5th MCQ. For the year ended 31st March 2016, Sizable Limited has taxable total profits of 820,000, and for the year ended 31st March, they had taxable profit of 970,000. The profits accrue evenly throughout the year. That means the profit figure for every month remains the same. Sizable Limited has 151% group company for many years. How will Sizable Limited pay its corporation tax liability? One thing which we have to keep in mind, that when the company has to pay the taxes will be dependent upon its size. Whether the company is going to be a small or medium-sized company, or the company is said to be a large-sized company. So could you see one thing, that the question is all about the year ended 31st March 2017. A company is said to be a large-sized company if it had also been a large-sized company in the previous period. So in the previous period, they had taxable total profit of £8,20,000. There were no dividends which were received from non-51% related group members in the question. So augmented profit is the same, 8,20,000. So this was the augmented profit figure for the last year for Sizable Limited. And a company is said to be a large company if their profits are going to be more than 15 lakh pound, provided company has made accounts for a year and it's an isolated company. That means they are not a part of a group. As far as this data is concerned, company has made accounts for a year. So 15 lakh limit for a year is like perfectly fine. But Sizable Limited has 151% related group company. So their limit for 1,500,000 has to be divided over the group number. As Sizable has 151% related company, so I can say that there are two companies in a group. So 15 lakh has to be divided over the group number, which is 2. So 750,000 is the revised limit. So if companies' augmented profits are found to be either equal to or less than 750,000, they are said to be small size companies. And if they're like augmented profit is like going to be more than 750,000 pounds, then they are said to be large size company. As you could see that their augmented profit is 82,000 pounds, which is more than 8,20,000 pounds, which is more than 7,50,000 pounds, which shows that Sizable Limited had been a large company in the previous period. So if you had been a large company in the previous period, it is going to affect your current period results. How the tax liability has to be paid for large size companies, tax has to be paid in 4 quarterly installments, and it is based on current period's corporation tax liability. So 970,000 is the current period taxable total profits. Corporation tax rate is 20%. So corporation tax altogether for the year is £194,000. This is the corporation tax for which 4 installments are to be made. So corporation tax liability into 25%. Each installment will be comprising over £48,500. So this is how 48,500 has to be paid in each installment for 4 installments, which are basically incurring on the 7th month of an accounting period. Then the second installment has to be made on the 10th month of an accounting period. Third installment has to be made on the 13th month of an accounting period. And last, the balance has to be paid on the 16th month of an accounting period. So option B is correct. Now I'm putting forward another MCQ in front of you, which is like very simple, and that is, for the year ended 31st December 2016, Lateness Limited had a corporation tax liability of £60,000, which it did not pay until 31st March. Lateness Limited is not a large company. So whosoever is not a large company will have to pay tax within 9 months and 1 day after the end of an accounting period. So their accounting period came to an end over 31st December 2016. Their due date had to be 9 months and 1 day after the end of an accounting period. So after accounting period, 9 months will be completed on 30th of September 2017, and the due date is 1st October 2017, being 9 months, 1 day after the end of an accounting period. So this was the last date by which tax liability had to be settled. But they had waived their tax liability on 31st of March. So we can easily see this thing that this company is late for 6 months: October, November, December, January, February, and March. These are the 6 months for which company had not made their corporation tax liability payments, for which interest will be charged. So question is that how much interest will Lateness Limited be charged by HMRC in respect of late payment of its corporation tax liability for this year? Could you see that their corporation tax liability is 60,000 and interest is charged at the rate of 3% on underpaid taxes, and as interest rates are meant for a year and they are just 6 months late, so we'll see this thing that how much interest has to be charged for this period. This is of £900, so option A is correct. Moving forward, MCQ number 7 is, on 26th of November 2016, Alice, individual, sold an antique table. Table, as you could see, it's a chattel for £8,700. So disposal has taken place for more than 6,000. The antique table, the chattel, has been purchased on 16th May for £3,800. So this is the rule over which I could say that disposal is for more than 6,000 and cost is for less than 6,000. When such question is tested in case of non-current assets, in case of chattels, in case of table, then we are supposed to compute gains by 2 ways. First one, that we'll have to compute the gain in an actual manner, in which we'll take the disposal proceeds, which is 8,700, and then we'll deduct the cost. The cost for the table is 3,800, and actually the gain figure is £4,900. Simultaneously, I'll be calculating the gain with the help of formula as well, where I take the gross disposal proceeds, which are £8,700. I'll be deducting 6,000 from it. It's a part of formula, and then the remaining value will be multiplied with a fraction of 5 by 3. So excess amount has to be multiplied with 5 and it's going to be divided over 3. So the remaining amount is £4,500. 4,500 and 4,900 taxpayer is given a choice to choose an amount of his own choice, and they would definitely prefer a lower figure. So option A is correct. 4,500 is supposed to be an answer for this part. Now I'm going to put another question in front of you, and that's question number 8. Once again, the question is, on 14th November 2016, Jane made a cash gift to a trust of 8 lakh pounds. After deducting all available exemptions, Jane paid the IHT arising from this gift. Jane has not made any other lifetime gifts. What amount of lifetime IHT would have been payable in respect of Jane's gift to trust? So IHT aspect is going to be tested over here. Whenever lifetime transfers are made, first step would be that we will have to see what the transfer of value is. Transfer of value is 8 lakh pound. And the most important thing is that the gift has been made to a trust. So it's a chargeable lifetime transfer which is made on 14th November 2016. That means in 1617, transfer of value was made of worth 8 lakh pounds. We'll first deduct the small gift exemption, which is not the case over here. Then I'll be deducting the marriage exemptions. Of course, this asset has not been transferred at the point of marriage, so marriage exemption is not going to work over here. And then annual exemption has to be deducted. But as you could notice that it is written in the question that this figure is like after deducting all exemptions. So I could simply say that this 8 lakh is more like a chargeable amount of gift. Out of transfer of value, small gift exemption, marriage and annual exemptions are to be deducted. This is how we come across chargeable amount of gift, and they have straight away said that this figure is after deducting all kind of exemptions. So I could rather say it as a chargeable amount of gift on which tax has to be paid. Whenever tax has to be paid, we'll see what an NRV is. NRV of the year of gift has to be made. In 1617, NRV is 3,25,000 pounds. This 325,000 rate will be given in your exam paper and rates and allowance table. But first that we have to check what has been transferred, what chargeable assets have been made in the last 7 years. As you could see that nothing has been transferred previously. So 325,000 NRV is available totally. So we'll see what is an excessive figure over and above the NRV limit of 325,000 pounds. That is 475,000 pounds, on which the rate of IHT has to be applied. Now, lifetime IHT would either catch the rate of 20% or 25%. That depends who is going to pay the tax, whether the donor of the gift or the recipient, the trustee of the gift. As it is like clearly written in the question that Jane is going to pay the tax, so the tax rate is going to be 25% of this figure, which is 1,18,750 pounds. So option C is correct. Moving towards the 9th MCQ. During the tax year 1617, Mildred made the following cash gifts to her grandchildren. Mildred has made the following cash gifts to her grandchildren: 400 to Alfred, individual has been given with 400, 140 to Minnie, a further 280 to Minnie, and 175 to Winifred. Which of the gifts will be exempt from inheritance from small gift exemption perspective? Keep one thing in mind: whenever a gift of either equal to or less than 250 is made to the same person in a particular year, then the gift is going to be exempt. As far as Alfred is concerned, he has been given with the gift of 400 in a year, which is more than 250, so it is going to be taken up. As far as 140 and 280 worth gift are going to be considered, they are going to be made to the same person, and altogether it is going to cross the limit of 250. So they are not exempt under IHT rules, under small gift exemption principles. But as far as Winifred is concerned, he is given with a gift of only 175 pounds, which is like less than 250, and that's the only gift that has been made to him. So it is only the gift which is like going to follow, which is going to fall under small gift exemption principle. So only fourth one is exempt under small gift exemption rule. Now moving towards the last MCQ. For the quarter ended 31st March 2017, Faro had standard rated sales of 49,750 and standard rated expenses of 22,750. Both figures are exclusive, net of value added tax. Faro uses the flat rate scheme to calculate the amount of VAT payable, with the relevant scheme percentage for the trade being 12%. The percentage deduction for the first year is not available, though this point is not examinable at FSITS level. So, moving forward, how much VAT will Faro have to pay for the quarter ended 31st March? Keep one thing in mind, that this person has made sales of 49,700 and this is exclusive of VAT. First point would be that we'll have to see this thing, that what is the gross amount of total sales that this person is receiving. 49,750 is the net figure. If it is a net figure, if it is like simply the figure, then what is the figure for VAT? VAT figure is 9950. So I can say the gross amount is net amount 49750 plus 9950. So the gross value will become 59,700. Whenever flat rate scheme is selected, we will have to take the gross amount of total sales. By gross, I mean to say whatsoever has been collected by the customers, that has to be taken up, and we will consider each and every type of sale, whether it's a standard rated sale, it's a zero rated sale, either if it's a reduced rated sales, and so much so even exempt sales are also considered. So each and every type of sale has to be taken up over its gross figure, whatever we had received from the customers. Gross amount of sale will catch the rate of 12% in this case, which is like given that 12% is the flat rate. This is not the standard rate. Each time flat rate will be given to the people in the question paper because it varies from business to business. So according to flat rate scheme, 7164 is the VAT figure which has to be paid to HMRC. Keep one thing in mind, that whenever flat rate scheme is like going to be considered, then purchases or expenses, input VAT is not going to be considered at all. Input VAT is ignored if in case flat rate scheme has been selected. So in this case, the correct answer is 7164 pounds. If in case you people have any kind of question, you may please write down in the dialog box. Then we'll move forward to the remaining questions. I'm going to repeat this MCQ once again. For the quarter ended 31st March 2017, Faro has standard rate sales of 49750 and they had made standard rated expenses of 22750. Both of these figures are exclusive of VAT. But this person has chosen flat rate scheme in order to compute VAT payable, and the relevant flat rate scheme is 12%. I was telling you people before that flat rate is not 12% always, rather it varies from business to business, and whatsoever the flat rate is, that will be given to you people in your exam. How much VAT will Faro have to pay to HMRC for this quarter? Keep one thing in mind: whenever the flat rate scheme has chosen up, gross amount of total sale has to be considered. By gross, I need to say that whatsoever you are going to receive from your customer will be considered, and you are supposed to take all types of sales in your question. Whether it's a standard rated sale, zero rated sale, 5%, reduced rated sales, or so much so exempt sales. All types of sales are going to be taken up. We'll make a total of it and we'll see that how much income has been received, how much sales have been received from the customer. Whatsoever the gross amount of sales are, we will have to pay VAT over it. As the flat rate is like 12%, then 7164 is the VAT figure which has to be paid to HMRC. Could you see one thing? As in the question, 49750 was the only sale figure which was given, and that was an exclusive of VAT figure. So first step which I had performed is that I had grossed it up. If 49750 was the net figure, then in practical we had charged 20% VAT to the customers, and this is how the actual VAT figure is 9950 pound. So the gross amount of sales are net amount 49750 and the VAT figure is 9950. This is how together it makes the gross amount of total sales, and on gross amount of total sales flat rate has to be applied. Flat rate, which is like given in this question, is 20%. So VAT payable will become 7164 pounds. As far as flat rate scheme is concerned, input VAT over purchases or expenses are not recoverable at all. I hope now the point is clear to you people. Okay, moving towards the 11th MCQ. Which of the following assets will always be exempt from CGT? A motor car. I need not to read the line completely, because whenever a motor car is sold, that is going to be exempt from capital gains tax purposes. A chattel need not to be exempt always. There are few chattels for which, even if life is supposedly short, less than 50 years, then they become wasting chattels. If a chattel is a wasting one, then it is going to be exempt. Otherwise, if a chattel is not a wasting chattel, then we will have to see this thing that for how much cost chattel has been purchased and what has been the disposal receipt. If both disposal and cost are found to be less than 60,000, though their life is more than 50 years, this becomes an exempt disposal. So all those chattels whose life are either equal to or less than 50 years, they are exempt. Other than that, if a chattel has been sold and purchased for less than 6,000 pounds, we are not going to calculate capital gains tax liability over it. They will become exempt. But as far as this statement would be concerned that a chattel is always exempt, that's not appropriate. Then a UK government security, gilt, or you can say it as QCB, qualifying corporate bonds. Whenever gilts, investment into government bonds, are disposed of, no CGT liability will be computed. And then comes a house. A house needs not to be exempt in every case. If in case this is your main accommodation, then gain could be exempt a maximum up to the period which is equivalent to the period of occupation. So as long as you stay in the house, the more gain will be exempt, but few gain will be left if in case the house had not been totally occupied for the, has not been like thoroughly occupied. So I can say which thing could be like always exempt from CGT, that is the motor car and the UK government security. So 1 and 3 are always exempt. So option A is the correct one. Moving towards 12th MCQ. Winston invested 8,000 into a cash ISA on 6th of April 2016. He withdrew 3,000 from cash ISA on 30th June. He now wants to invest more funds into the cash ISA over the remainder of the tax year 16-17. What is the maximum possible amount which Winston can invest into his cash ISA for the remainder of the tax year? Keep one thing in mind, he invested 8,000 and then he withdrew 3,000 from it. Could you please take a minute and solve this question? Keep one thing in mind, that the ISA limit for 16-17 is 15,240 pounds. Keep one thing in mind, that the maximum amount that could be invested into ISA is 15,240, and this ISA limit will be provided to you people in your exam. That is supposed to be a very simple MCQ. Could you please answer it? Perfectly fine. 10 to 40 is the correct answer. 10 to 40 is the correct answer. As you could see that 15,240 is the maximum limit. Though Winston had invested 8,000 into it, but then he withdrew 3,000. So till now 5,000 is there in his cash ISA. Further 1040 could be invested as well in the same tax year. So 10 to 40, option B is correct. Then comes 13th MCQ. Ming is a self-employed person. How long must she retain the business and the non-business records used in preparing her self-assessment tax return for the tax year 16-17? For all those people who are running the business, or I can say other than employees, each and every person is like supposed to retain their records for 5 years after 31st January following the tax year. 5 years after 31st January following the tax year, whether the records are of like business in nature or they are non-business records. It's like, it doesn't make a difference whether the business records are to be kept or the non-business records are to be kept. It's just that what a person is. If a person is self-employed, other than employees, 5 years after 31st January rule has to be applied. So in the tax year 16-17, after the end of this tax year, 31st January will appear on 31st January 2018 and we'll have to count 5 years from this date. So 5 years will be completed on 31st January 2023. So I can say that option C is correct, that both business and non-business records are to be kept by Ming for till 31st of January 2023. Then comes the 14th MCQ. Moon Limited has had the following results. Year ended 31st December 2016, there is a loss of 1,05,000 pounds. Then 4 months accounts were made and the profit is 43,000, and then once again 12 months accounting period is made in which profit is 96,000. The company does not have any other source of income. How much Moon Limited trading loss for the year ended 31st December can be relieved against its total profit of 96,000 pounds for the year ended 31st August 2015? Keep one thing in mind, they had a loss of year ended 31st December 2016 of 1,05,000 pounds. Whenever losses are carried forward, then they are going to be adjusted in the immediate future against the immediate future period. So considering the immediate period, the profit figure is just 43,000 pounds. So out of 1,15,000, 43,000 will be adjusted in the next period, and this is how a loss of 62,000 will be left, which will be adjusted in the next accounting period, which is going to be ended on 31st of August 2015. So in this case, option D is correct. Whenever there is a trading loss and it is going to be carried forward, it is always carried forward against trading profit of future accounting period. As the next trading profit was 43,000, so first adjustment has to be made against this amount, and then the leftover loss of 63,000 will be adjusted in the further accounting period. Last MCQ of section A, that's Nigel has not previously been resident in UK, being in the UK for less than 20 days each tax year. For the tax year 16-17, she has 3 ties with the UK. What is the maximum number of days which Nigel could spend in the UK during the tax year 16-17 without being treated as UK resident person? So she had been living in the UK for less than 20 days for the last few years, and which is why she has not been previously resident. A person who had not been previously resident, now she wants to come in 16-17 again, and she has 3 ties. How many days she should spend without being treated as a resident person? So the answer to this question could easily be understood with the help of rates and allowance table. In rates and allowance table, UK resident criteria has been given. So I can say that I will have to select whether the previously resident criteria or the not previously resident criteria. As it is said that Nigel has not been previously resident, so I have to take this thing into account. She'll be treated as resident if she has 3 or more UK ties, if she spends a time period of 91 to 120 days. But as far as less than 90 days are concerned, more than 121 days are concerned, even on fulfilling the 2 UK ties, she'll be treated as resident. So what can I say over here is, if she stays for 91 to 120 days, and as she's having 3 UK ties, she'll be treated as UK resident. But as the question is that how many days she should spend, even then she is not going to be treated as a UK resident person. She needs to have 4 ties, and this criteria would be fulfilled if she is going to stay for maximum of 90 days. So if she stays for maximum of 90 days, she will not be treated as a UK resident person, because to be considered as a UK resident person, at least 4 ties are to be met, and she has only 3 UK ties. So option A is correct in this case. If in case they would say that when would she become a resident person, so I could say that whenever she's going to spend 91 days or more than 91 days in the UK, but as they said, when she had not to be treated as a UK resident person, so I would say that maximum if she spends 90 days in a UK, she will not be treated as a UK person. If you people have any question related to the remainder 5 MCQs from MCQ number 11 to MCQ number 15, you may please write down in the dialog box. And afterwards, we'll move to section B. Okay, moving towards section B of this paper. Section B is once again comprising over 15 questions which are compulsory and they are supposed to be attempted. Once again, workings are not required. It's only the answer which matters. If answer is correct, then you will be rewarded. Now the section B is going to be tested in an OT case style in which 3 OT cases will be given to you people in your question, and against each OT case 5 MCQs are answered. The first scenario is like there in front of you, and it's like relevant to MCQ number 16 to MCQ number 20. Delroy and Marlon. On 10th of January 2017, Delroy made a gift of 25,000 one-pound ordinary shares in Duck Limited, an unquoted trading company, to his son, Grant. The market value of the share on that date was £240,000. Keep one thing in mind, whenever the gifts are made, it's actually the market value at the date of gift which should be taken as disposal receipts. Delroy had subscribed for the 25,000 shares in Duck Limited at par over its face value on 1st of July 2006. Delroy and Grant have elected to hold over the gain as a gift of a business asset. Grant sold the 25,000 shares in Duck Limited on 18th March. So Delroy had made a gift to his son Grant, and Grant had eventually sold 25,000 shares on 18th of March 2017. Duck Limited has a share capital of £1 lakh. So if I see that if someone has 25,000 shares out of an issued share capital of £1 lakh, so we can say that the shareholding was 25%. Delroy was the sales director of the company from its incorporation since 1st of July 2006 till the date he had given these shares to his son, and Grant has never been an employee or a director for the Duck Limited. So if in case on 10th of January Delroy had made a gift to Grant, gift relief is possible, but entrepreneur relief cannot be available. As you could see, in order to claim an entrepreneur relief, 2 conditions are said to be satisfied. First one is that shareholding has to be at least 5%, plus the donor or the person who is going to sell the shares had to be an employee or officer of the company. Could you see that Delroy was the sales director and he was holding 5% of the company? So he could be able to get an entrepreneur relief, but Grant could not be able to get an entrepreneur relief because shareholding is supposed to be significant, but he had never been an employee. And above all, he did not retain the shares for a significant time period. In order to go for entrepreneur relief, any asset which is going to be sold has to be held for at least 1 year before the date of basically sale. So first thing would be what that I'm going to check that what first MCQ is all about. What is the grant's CGT liability for the tax year 16-17 in respect of disposal of the shares in Dub Limited? So first of all, Dilroy and grant relationship has to be considered, because whenever such statements are given in the question in which multiple dates are given or multiple sequences are given, we are supposed to deal with the situation or in a chronological way. That means that we'll have to deal with the situation which comes earlier, which happens on the earliest date. So the first scenario was that Dilroy had made a gift to his son. Could you see that when Dilroy had made a gift, disposal was taken place over its market value, and the market value was £240,000. The cost of the gift's shares were 25,000. How could I come to know that the shares cost was 25,000? Because he had got 25,000 shares at par, and as it has a face value of £1. So that means that 25,000 shares have been purchased for £25,000, and as a result of this, the gain generated by the gift that has been made by Dilroy was £215,000. As you could see that whatsoever the disposal has to be taken in case of donor's case will be taken as donee's cost. But another situation was that they had elected to hold over the gain over the gift of a business asset. That means if business asset has been transferred and there is a mutual consensus between the donor and donee of the asset, gift relief is also possible. As you could notice that Dilroy did not receive anything from his son, so the whole gain is going to be held over as in case of gift of a business asset. So gift relief is going to be applied in this case, and gift relief is going to be deducted from the cost of donee's asset. So out of 240,000, 215,000 will be deducted. So base cost for donee will become £25,000. And eventually the donee, Grant, has sold the shares, and he has sold the shares for £240,000. Against 240, 25,000 will be deducted, and once again Grant's gain will be £215,000, on which he will have to pay the tax. It is like written in the question that both Dilroy and Grant are high rate taxpayers. They have made other disposals as well, and therefore they have already utilized their annual exempt amount. If this line wouldn't have been written, then first step had been that I would be deducting annual exemption of 11,100 from the figure of gain, but that's not so the case, because they've said that annual exemption is like already used. So over this figure rate has to be applied. Normally the rate of gain is 10% if in case gains are found to be in the basic band, and the rate of tax will be changed if gains are found in higher band. Except for the residential properties where the basic rate gain figure is percentage is 18%, and the rate for CGT in higher band is 28%. These are the normal gains on which 10% rate has to be applied. 20% rate has to be applied, because he is already a high rate taxpayer, so his tax liability will be £43,000. So which option is correct? That is option A. Now moving towards another MCQ. What would the CGT implication have been if Dilroy had instead sold the 25,000 shares in Dub Limited himself for 240 and then gifted the cash proceeds to his to his son, basically? Keep one thing in mind: if in case Dilroy had made a disposal, then he had to compute obviously the gain. Disposal was 240,000 and his cost was 25,000. So a gain of 2,15,000 would be generated. But as Delroy would be able to get entrepreneur relief, as I had discussed this point before, then the rate of 10% will have been applied. No wonder he is a high rate taxpayer. Still, whatsoever the gain qualifies for entrepreneur relief will always catch the rate of 10%. So this is how the tax rate would have been tremendously reduced. That would become 21 lakh for 500 pounds, except for the excessive gain, which could be charged over the normal rates of 20%. And if in case he then gives the cash proceeds to his son, no CGT implication will be imposed, as CGT is applied over the disposal, over the transfer of non-current assets, and cash is a current asset, so no further implication of CGT will be imposed. Yes, but inheritance tax would be considered if in case something has been transferred either in lifetime or after the death, but so much so it is not going to be a material case, because whensoever anything is like going to be given to an individual, as in this case Delroy has made a transfer to his son to another individual, this is going to be like potentially exempt transfers during lifetime. And then if donor is going to die after 7 years of making the gift, even then Aisha is not going to be charged. So as far as this MCQ is concerned, that entrepreneur relief would have been available, that's perfectly fine. CGT liability would have been paid later. No, there would be like no impact on CGT liability, because as we could all see that both disposals, whether Delroy will be making the disposal or Grant would make a disposal, they appear to be in the same tax year. So CGT liability would have been paid on the same date. As far as the third point is concerned, the cash gift would not be a chargeable disposal. That's a perfect statement. And then the last one, the cash gift would have qualified for holdover relief. Cash gifts are basically nowhere in case of CGT, as capital gains implications are not going to be over cash gifts, so holdover relief is never possible. So I can say first and the third statements are concerned. So in this case, once again, option A is the correct one. Now the third MCQ is related to marlins. For that purpose, I will have to read the other passage. Here you go. Marlin and Elvita. On 28 March 2017, Marlin sold a house for £497,000, which he had owned individually. The house had been purchased on 22nd of October 2001 for 152600. Throughout the period of ownership, the house was occupied by Marlin and his wife Elvita as the main residence. Though Marlin used to have this house individually, so it does matter regarding period of occupation that the owner had been living in this house or not. 1/3 of the house was always used exclusively for business purposes by the couple. Entrepreneur, of course, is not available in respect of this disposal. For the tax year 1617, Marlin is a high rate taxpayer, but Elvita did not have any taxable income, so she her basic rate band is like still available. But as far as Marlin is concerned, he is already a high rate taxpayer. So whenever he is going to pay CGT liability, he would pay it off at the rate of 28%, because now the case is all about residential properties. This will remain the case for the tax year 617-18. Neither of them has made any other disposals during the year. So class, keep one thing in mind, that they have sold the house for £497,000 and the house had been purchased on for 152,600. So their gain figure is 497,000 minus 1,52,600 pounds. So their gain figure is 3,44,400 pounds. And this is Marlin's gain, on which he will have to compute CGT liability. 3,44,400 is the gain that should be kept in mind. So as you could see that his gain is 344,400, and as they all say that they did not make any other disposal, so current year losses, brought forward losses are not going to be considered, but yes, annual exemption is. Annual exemption for CGT purposes is 11,100 pounds, so taxable gain will become 3,33,300 pounds, over which tax rate has to be applied. As this is the case of residential property and Marlin is a higher rate taxpayer, so the tax rate of 28% has to be applied. In this case, tax liability will be 93,324. I have computed extra figures for you people, but they were just asking what is the chargeable gain. The gain figure was 3,44,400, but I was like extending the question just to let you people know, if in case they had asked that what could have been the tax liability, then tax liability had to be computed at the rate of 28%, because that's not the normal gain, rather it's a gain of residential property. But as it is asked that what is the chargeable gain, the chargeable gain figure is 3,44,400 pounds. So which option is correct? Sorry, one thing has been left. Though the gain is 3,44,000 pounds, but as you could see, that was the main accommodation of Marlin, on which principal private residence relief has to be applied as well. This is the thing which I forgot while shifting the screen. So 3,44,000, though this is the gain, but this will qualify for principal private residence relief. Though Marlin had totally occupied the house for the whole period of ownership, I need not to take this thing into account that what had been the period of occupation or period of non-occupation, because the whole period had been taken as a period of occupation. But as you could see that it is said that 1/3 of the house has always been used for business purposes. So as 1/3 of the house has been used for business purposes, this portion of the house would never qualify for PPR. So this is going to be the chargeable gain. As far as 2/3 of the property is concerned, that has been occupied thoroughly for private purposes by the owner, and this is how 2/3 will be exempt under PPR rules, while 1/3 has been used for business purposes, so it is going to be the chargeable gain. 3,44,400 into 1/3, and that is 114,800. So the correct answer, obviously after getting PPR, is 1,14,800. If in case it is asked in the question that what would have been the gain before PPR, then the answer would have been D, option D. But as they said that this is the main accommodation, it is quite understood that they would go for principal private residence relief. Then comes MCQ number 19. What is the amount of CGT which could have been saved if Marlin had transferred 50% ownership of the house to Elvita prior to its disposal? As you could see that 1/3 of the property is chargeable, and the chargeable gain is 114,800. In this case, if Marlin had transferred 50%, half of the ownership to Elvita, then in this case 50% gain would be chargeable over Marlin and 50% would be chargeable over Elvita. Gain figure is 114,800. Its 50% is 57,400 for Marlin and 57,400 for Elvita. But before that, I see that how much tax would be paid in case Marlin and Elvita will be sharing the gain. I need to see that what had been the tax figure before, if in case Marlin himself will be selling the property. In that case, the chargeable gain was 1,04,800 pounds. Of course, he did not have any other disposals, so he'll be deducting only annual exemption of 11,100. And As a result of doing this thing, his taxable gain will become 1,03,700 pounds, on which tax of 28% would have been applied. Annual exemption would be available because it is said that he did not have any other disposals. So annual exemption will be adjusted against this gain. And as this gain relates to the residential property and simultaneously he is a higher taxpayer, so the rate of 28% has to be applied. So CGT will become 29036. This is the capital gains tax liability that could have been paid if Marlon himself will be making a disposal. But if in case he is going to sell 50% shares to Elvita, gain would be split in between Marlon and Elvita. As a result, Marlon will be paying tax at the rate of 28% because he is already a higher rate taxpayer, but of course after deducting annual exemption, 57,400 less 11,100, taxable gain would then become 46,300, on which 28% rate will be applied, and that is 12,964. By the way, the rest of the gain is going to be charged upon Elvita, as she did not make any other disposals in the same tax year. Let me see this point again, that Elvita did not have any taxable income and neither of them had made any other disposal. So the point is, as she did not have made any other disposals previously in the same year, so it is like possible to get annual exemption in this case as well. So it is like if in case ownership of the house is transferred to Elvita, they both will be able to use their annual exemptions. Again, 57,400 less 11,100, remaining amount 46,300, on which keep one thing in mind, basic rate of 18% will be applied over again till 32,000 and remaining gains will catch the rate of 28%. First of all, why did I use the rate of 18 and 28%? Because that's the gain relates to residential properties. But as we could easily see this thing, that she did not have taxable income, so her basic band is still there fully. Out of 32,000, which is going to be like adjusted in basic band, her taxable figure is 46,300 less 32,000. Remaining gains are going to be taken under higher band. So leftover figure is 14,300, on which 28% rate has to be applied. 18% is charged on 32,000 of the gain, which is 5,760, and 14,300 is going to be charged at the rate of 28%. And the answer is 4,004. Total, it will become 4,580. So we could see this thing, that if in case Marlon had transferred 50% ownership to Elvita before the disposal, 12,964 is the tax liability which is going to be paid by Marlon, and 4,580 will be the tax liability that will be paid by Elvita. So the total tax liability will then become, this is 17,544. 17,544. As compared to this figure, with what Marlon would be paying individually, we could see this thing, that tax liability is going to be saved, and is going to be saved with So repeating the situation again, if Marlon had paid the taxes, then he would be paying tax at the rate of 28%, and the tax liability would then be 29036. If in case he had transferred half of the ownership to Elvita, so she will also be able to utilize the annual exemption. Marlon will eventually be paying tax over 46,300 at the rate of 28%, and the answer is 12964. And Elvita's gain are going to be taxed at the rate of 18% for first 32,000, and the remaining gain will be taxed at the rate of 28%. And this is how the total tax liability was 9764. 9764 would be the tax liability of Elvita, and 12964 is the tax liability of Marlon. So the total tax liability is 22728, and that would be paid if in case this property's 50% ownership has been transferred to his spouse. As a result of doing this thing, we could easily see that how much tax liability would be saved. 12964 is Marlon's tax liability. Elvita's tax liability is 9764. Total is 22728 as compared to 29036. 6308 tax liability is going to be saved. So option B is correct. Okay, moving towards the next MCQ. What would it have been beneficial if Marlon had delayed the sale of house until 5th April? If in case they do not sell this property until 5th April, next tax year would be started from 6th of April 2017, and the gain will fall in the other tax year, that's 17-18. And as a result of doing this thing, Marlon will be obviously able to like defer his gain till 31st of January of the subsequent year. And this is how which option could be correct is that if I see A option, a low rate of CGT would have been applicable. That's not the case. There could be a chance that Marlon will again be a high rate taxpayer in the next tax year, and which is why he still need to pay tax at the rate of 28% in the next tax year. So that's not the obvious case. Then as far as option B is concerned, 2 annual exempt amount will have been available. No, that is a complete nonsense. Annual exemption is 11,100 for a year. If in case you do not use any annual exemption in the current year, it is not going to be transferred to the subsequent year. Then principal private residence leave would have been greater. That's not even the case, as Marlon had been able to use the whole PPR rule because he had thoroughly occupied the property. So there would be like no impact over principal private residence relief figure. But as far as option D is concerned, that CGT liability would have been paid later, then yes, it would have been like deferred for the next year. Moving towards the next OT case. That is the case for Opal. The following scenario is related to the question number 21 to 26. You should assume that today's date is 15th of March 2017, and this date falls in the tax year 1617. Opal is aged 71 and has a chargeable estate of 950,000. She owns 2 properties respectively at 374 and 442,000 pounds. The first property has an outstanding repayment mortgage of 160,000, and the second property has an outstanding endowment mortgage of 92,000 pounds. Keep one thing in mind: simple repayment and interest only mortgages are deductible, while the endowment mortgages are not going to be deductible at all. Opal owns 22,400 in respect of a personal loan from a bank, which she has also verbally promised to pay legal fee of 4,600 incurred by nephew. As she has taken a loan, it is her legal obligation to pay it off. And if in case she doesn't pay it off and she dies, then this amount will be paid out of her estate. As far as verbal promises are concerned, they are not going to be entertained at all. Opal expects the cost of a funeral to be 5,200. That's totally deductible, and this cost will be covered by 6,000. She has invested into ISA. Whatsoever you are going to give away, whether it's like ISA, cash, or building, whether it's like non-current asset or current asset, it's like going to be totally chargeable. Under the terms of her will, she has left all of her estate to her children, and her husband is like still alive. On 14th of August 2007, Opal had made a gift of 1 lakh to her daughter, and on 7th November 2016, she made a gift of 220,000 to her son. Both figures are after like deducting all available exemptions. The nil-rate band for the taxi 7/8 is 3 lakh. You should assume that the value of Opal's estate and nil-rate band will remain unchanged for future years. That means that it had to be taken over 3,25,000 pounds. What is the net value for the two properties and related mortgages which have been included in the calculation of Opal's chargeable estate of 950,000? The calculation is very easy. As you could see that the first property's worth is 374,000, against which repayment mortgage has to be deducted. So 374 minus 160, net value has to be like for the first property 2,14,000 pounds. And as far as second property is concerned, the value of the estate is 442,000, on which endowment mortgage is taken up. Endowment mortgages are not going to be entertained at all because they are supposed to be paid automatically from as per insurance policy at owner's death. So 214 plus 4,42,000 pounds, the net value of her figure which has to be included in Opal's estate has to be like what? This is 656,000 pounds. So it was an obvious MCQ for which option C is correct. Then comes 22nd MCQ. What is the total amount of deductions in ignoring mortgage debt which will have been permitted in calculating Opal's chargeable estate of 950,000? I'm going to repeat the question. What is the total amount of deductions? They're just asking about the deductions figure. Which will have been permitted to be deducted from Opal's chargeable estate, death estate basically. As you could see that she has taken a loan, it is perfectly deductible. Verbal promises are not deductible, and funeral expenses are also deductible, which are going to be like 6,000 of her estate. But the point is 6,000 is like your investment in ISA, which has to be taken as a part of your asset, and then 5,200 will be deducted as an expense. So this is how the case is simple, that 22,400, which is bank's loan figure, plus 5,200, which is her funeral expense. The total expense that is permitted to be deducted from her death estate is going to be of 27,600 pounds. So as this option D is correct. Then moving quickly towards the 23rd MCQ, it is said that what amount of IHT will be payable in respect of Opal's chargeable estate valued at 950,000 were she to die on 20th March 2017. If in case she dies on 20th March 2017, that means in the tax year 16-17, and her chargeable estate is going to be valued over 950,000, then what is going to be her IHT? As you could see that they did not say that we are supposed to take into account all the available deductions and everything in our account. We just need to consider amount of IHT over the chargeable estate of 950,000. Considering gross chargeable estate is 950,000 and she did not leave anything to her husband, so there is no exempt legacy to spouse. Afterwards, nil-rate band of 3,25,000 has to be considered. But as you know, the 325,000 has to be adjusted for the last 7 years. All those chargeable transfers which were made in the last year from the date of gift will have to be considered. For that purpose, I'll see the passage again, that how many estates were given in her lifetime. It is like that on 14th August 2007, she made a gift of 1 lakh to her daughter. And then 220,000 was made to her son. Considering from the date of death, if I look back to the 7 years, this gift does not exist. So in the last 7 years, this gift is only existing. So my nil-rate band is going to be affected by the value of 2,20,000 pounds. Though we need to take gross chargeable amount, but as you could see that they say that this 220,000 figure is like after deduction of each and every kind of exemption. So I'm going to take it as it is because that's the gross chargeable amount. So NRB of 1,05,000 is still available. If 1,05,000 is the NRB, I need to see that how much value is taxable. 950,000 minus 1,05,000. The answer is 8,45,000 pounds, on which IHT on death estate has to be computed, which is always computed at the rate of 40%. So the answer is 3,38,000 pounds. Option B is correct. Moving towards 24th MCQ, by how much would the IHT payable on Opal's death be reduced if she were to live for another 7 years until 20th March 2024, compared if she were to die on 20th March. If in case she dies on 20th March 2024, this date falls in the tax year 23-24, the chargeable estate I assume remains the same, 950,000, and out of which NRB will be like completely available. How is that possible that NRB is completely available? Because in the last 7 years from the date of death, no previous lifetime chargeable transfers will be existing, so whole of the nil-rate band will be available. And as a result of this, IHT liability will be reduced, though the rate I assume remains the same. This is how the tax liability will become 2,50,000 pounds. As they say that how much it is going to be reduced, so I'll compare the two figures. If in case she dies now, tax liability is 338,000. If she were to die on 20th March 2024, then tax liability is this. By comparing these two figures, I come to know that how much tax liability would be reduced, that is of 88,000 pounds. So option A is correct. Now comes 25th MCQ, the last MCQ of this OT case. Which of the following conditions must be satisfied if Opal wants to make a gift out of her income so that these gifts are exempt? The gifts cannot exceed 10% of the income. That is not the case. There is no such rule where your income is not going to cross the limit of 10% of your income. It doesn't catch IHT. That's not the case. The gifts must be habitual. Yes, if the gifts are of habitual in nature and after giving the gift, donor does not feel a substantial reduction in his or her estate, then I could say that this is a normal expenditure out of income for which no CGT has to be, no IHT has to be imposed. Opal must have enough remaining income to maintain her normal standard of living. Yes, of course, that she would feel as if she still has substantial income left with her. And Opal makes a gift monthly or quarterly. That doesn't make a difference. So second and third condition are the correct conditions under which her income is like going to be exempt from IHT. So if in case you people have any question related to the first OT cases, you may please write down in the dialog box. So moving towards the last OT case of this paper, that's Glacier Limited. The following scenario relates to the question 26 to 30. The following information is available in respect of Glacier Limited's value added tax for the quarter ended 31st March 2017. So that means January to March 17 calculations are to be performed. Number one, invoices were issued for sales of 44,600 to VAT registered customers. Of this figure, 35,200 was in respect of exempt sales and the balance is in respect of standard rated sales. The standard rated sales are, that standard rated sales figure is exclusive of VAT. I'm going to come to the MCQ number 26 simultaneously. Could you see that what they have said, that what is the amount of output VAT payable in respect of sales for the quarter ended 31st March 2017? As we could see that total invoices were of 44,600, out of which 35,200 was in respect of exempt sales on which no VAT has to be applied. The balance will catch the VAT rate of 20%. So 44,600 minus 35,200. The balance is 9,400, and this figure is like going to be exclusive of VAT. So this is the net figure on which VAT rate of 20% has to be applied. And the answer is 18. and the answer is 1880. This is just for the first paragraph. But if I consider the second thing in which output VAT is still there, because they are also going to make a sale in the second point as well, I need to take it into account as well. In addition to the above, on 1st March, Glacier Limited issued a VAT invoice of 8,000 plus VAT of 1,600. So you could see that on 1st March, this is an invoice date. 8,000 plus VAT of 1,600 has been charged. Now the contract is going to be completed on 15th of April 2017. This is the contract completion date, the date on which services are performed, and then cash is going to be received in 2 installments. First installment is like of the half of the figure, which is going to be received on 31st of March, and then the remainder half is going to be received on 30th of April. So as you could notice one thing, that whenever goods are delivered or services are performed, tax point rules are important to be considered. The date on which goods were delivered or services are performed, in this case it's a service, that's 15th April 2015. But the two exceptions of tax point have already been discussed, that whether the cash is going to be received in advance or invoice is going to be issued in advance. As we could all see that half of the cash is going to be received in advance and the invoice is like going to be issued on the earliest date. So this is actually the invoice date which is going to fulfill the exception, and I'm going to take it as a tax point. 1st March 2017, this falls in this quarter, so it is also going to be included in our computation. So total 1,600 is the VAT. The examiner has already computed the figure of VAT. We need not to apply the rate. So total output VAT due for this quarter will be 1880 plus 1,600, that is 3,480 pounds. So option B is correct. Then comes MCQ number 27. What output VAT and input VAT will Glacier Limited will include on its VAT return for the quarter ended 31st March 2017 in respect of Managing Director's car? Now I'm going to read this passage, that the Managing Director of Glacier Limited is provided with free petrol for private mileage driven in her company car. Keep one thing in mind: whenever the car is purchased, whatsoever the VAT you pay, that is totally irrecoverable. But whenever you are going to incur any running expense over the car, that is like totally recoverable. So during this quarter, the total cost of the fuel for the business private mileage was 720, of which 270 was for private mileage. The relevant quarterly scale is 415 pounds, and these figures are inclusive of VAT. People just take a minute and calculate VAT liability over it, that what has to be the output VAT figure and what has to be an input VAT figure. Just write down in the dialog box. Okay, as I do not receive a response from you people, I am going to create it myself, though it's very important to be conscious and attentive while reading the question and solving it out, because only it's a practice which makes you pass the paper. A response has been received, which is related to option A. I'm going to solve it first, then I'll tell you whether it's correct or not. Fine. As far as the fuel is concerned, it should be taken as a running cost of the car, and over the running costs, whatsoever the VAT you pay on it, that's totally recoverable. So I will not make a difference in between the private use or the business use. Rather, I'll take the figure in full. This is the cost of fuel on which VAT has been paid. So how much VAT is recoverable? This should be taken as a gross figure. I would multiply this figure with 20 over 120 fraction to see that how much VAT is going to be recoverable, and that is 120 pounds. So input VAT is 120. As far as output VAT is concerned, that is going to be charged over the fuel scale charge. Fuel scale charge is the figure on which we assume that we have supplied the fuel for free. 415 is once again inclusive of VAT figure. It should be multiplied with 20 over 120 fraction, and this results into an output VAT of 69 pounds. So which option is correct? That's the correct option is option D, where output VAT is 69 and input VAT is 120 pounds. Second last MCQ of this scenario. What surcharge penalty could Glacier Limited be charged if the company is 1 month late in paying its VAT liability for the quarter ended 31st March 2017? For that purpose, I'll be reading the last passage of this OT case. For the quarter ended 30th September 2015 and 30th June 2016, Glacier Limited was 1 month late in submitting its VAT return and paying the related VAT liabilities. Could you see one thing? If in case for the quarter ended 30th September 2015, they did not pay their related VAT liability, a surcharge liability notice will be issued, which had to run from quarter ending date to 1 year. That means till 30th September 2016. But no penalty will have been charged because this is the first notice that has been served. On 30th June 2016, when the previous notice was not expired, another default was made, which is why another liability notice will be served, which will run from quarter ending date to the next year till 30th June 2017. And as it is a consecutive second default, a surcharge of 2% will be imposed. So whatsoever the VAT payable for the quarter ended 30th June, 2% penalty of VAT payable will be charged. Now this second default will come to an end over 30th June 2017. Moving towards this 28th MCQ, they say if the company is once again 1 month late for the quarter ended 31st March, then what is going to be the consequence? Once again, on 30th June 2017, the previous notice had to get expired, and in the meanwhile, another default has been made. So first of all, surcharge liability notice will be issued, which will run from quarter ending date to the whole year till 31st of March 2018. Plus, as it is a consecutive third notice, second default will be charged. As a result of third consecutive notice, default of second time will have to be imposed, which is 5% of VAT liability. So option A is correct. Then comes, sorry, that was third last MCQ. Then comes the second last MCQ for this OT case. What is the minimum requirement which Glacier Limited needs to meet in order to revert to a clean default surcharge period? Whenever a taxpayer keeps on submitting its VAT return and related VAT liabilities for the 4 consecutive sessions for the full year, for the full year on timely basis, then the surcharge period will revert to a clean record. That means the previous default will be elevated and they will revert back to a clean default surcharge record. So I can say if they submit 4 consecutive returns on time, that means for the next full year, the returns are going to be made on time, and they also pay their related VAT liabilities for the 4 consecutive returns on time. This is how they'll revert back to a clean default surcharge record. Last MCQ of this OT case, in which circumstances will Glacier Limited be required to issue a VAT invoice? Whenever a seller is registered, he or she, or actually the business is required to issue an invoice. But if in case sale is like of a zero rated supply, or if a customer himself is not a registered one, then it needs not to issue a VAT invoice. In that case, if you don't issue a VAT invoice, it doesn't create a difference. So option A is when a standard rated supply is made to any customer. Second is when any type of supply is made to any customer, when a standard rated supply is made to a VAT registered customer, and then when any type of supply is made to a VAT registered customer. Out of all this, option C is the most appropriate and the correct option, because whenever you are registered, you are making standard rated supply and your seller is also registered, then it's must, then VAT invoice has to be issued. That's the only case in which they are compulsorily required to issue VAT invoice. This is how next 5 MCQs related to the third OD case have been discussed. If you people have any question, you may please write down in the dialog box. Okay, there is like no question from your side. I'll be quickly going through the section C. I will not be solving the question section C. Rather, I'll be discussing the individual treatments with you people simultaneously. Now, moving to section C, all 3 questions are compulsory and must be attempted. Keep one thing in mind that for this part of the question, workings are mandatory. If you don't show the workings, you will not be rewarded. So, Sarah is currently a self-employed person. If she continues to trade on self-employed basis, her total income tax liability and NIC for the tax year will be 12631. She does not have any employees and therefore cannot currently make use of the 3000 employment allowance. However, if Sarah is considering incorporated her business on 6th April, the forecast taxable profit of the new limited company for the year ended 5th April 2011 will be 50,000 before taking account of any director's remuneration. Sarah will pay herself a gross director remuneration of 30,000 and dividends of 10,000. The balance of the profit will remain undrawn with the new company. That means that the balance of the profit will remain with the company. Required determine whether or not there will be an overall tax saving and NIC contribution for the year ended 5th April 2017 if Sarah incorporates her business. I'm telling you one thing, that if in case she incorporates a business, she will have to pay tax, she will have to pay NIC class 4 over tax adjusted trading profit. As the trading profit is 50,000 and after deducting employee's salary of 30,000, TATP, tax adjusted trading profit, will just be 20,000. Being a self-employed person, she will have to pay class 4 NIC and class 2 NIC over it. Class 4 NIC is dependent on tax adjusted trading profit of 20,000, while class 2 rate is like a fixed one. A flat rate of class 2 NIC has to be imposed. But then whatsoever she's like going to receive as in the capacity of an employee, she will have to pay class 1 primary over it. But keep one thing in mind, from company's perspectives, from employer's perspective, whatsoever the class 1 primary which Sarah is like going to pay, they will have to pay class 1 secondary, that's 1 secondary simultaneously, out of which employer allowance of 3,000 will also be available. but whatsoever she is going to get as in the form of dividends, neither company nor Sarah will be entitled to pay any kind of NIC. So this is how we'll see that how much tax liability is like going to be reduced. I'm going to like show it to you what tax liability could have been saved. As you could see that she is going to get a director remuneration of 30,000 plus dividends of plus dividend of 10,000. Afterwards, of course, you will need to like deduct her personal allowance. Taxable amount will be 19,000 for non-saving and 10,000 for dividends, over which income tax rates are imposed. And as a result, her tax liability has become £4,175. Considering this is going to be her tax liability over the income she is going to receive in the capacity of a director and being a shareholder, simultaneously few NIC implications are also going to be imposed, which I have discussed with you people. Let me show it to you. Class 1 NIC, being an employee, will be paid by Sarah over her 30,000 income, and this is like 2633, and her employer, the company itself, will have to pay class 1 secondary at the rate of 13.8%, which is 3021. See, the employment allowance is not available because she is the sole employee. That was the important point to be considered. If there were multiple employees in the company, then of course employer allowance of 3,000 would have been available. But if she is the sole company, these are considered to be like employee controlled companies. In this case, where sole person is like running the company, the opportunity to get employment allowances lost. But if in case along with Sarah, like multiple employees will be working in the same company, employer allowance of 3,000 would have been available. Considering the company's results itself, company's trading profit of 50,000, out of which director's remuneration, whatsoever the class 1 secondary NIC they pay for the employees, all expenses on the behalf of employees are going to be deducted. As a result of this, the trading profit for the company will only be 16,969, over which corporation 979, over which corporation tax of 3396 will be paid. So we could see the total tax and NICs in this case would have been 13,225. So if in case she's going to incorporate her business, there would be a tax saving. As it is like written in the question that 12631 is currently the tax liabilities and NICs, which is like paying in the current scenario. If she like reverts to this situation, 13,225 will be paid. So there is like not going to be any kind of saving. Rather, she will have to suffer with an extra expense of £594. Considering if she is like continue to be a self-employed person or she incorporates a company. If in case you people have any question related to this part, you may please write down in the dialog box. So the second question is of Simon. On 6th April 2016, Simon commenced employment with ACCA Limited. On 1st January 2017, he commenced in partnership with Art running a small music venue, preparing account for 30th April. The following information is available for the tax year 16-17. Number 1 relates to employment. During the tax year 16-17, Simon was paid a gross annual salary of 23,700. Throughout the tax year 16-17, Eco Limited provided Simon with living accommodation on which taxable benefit has to be generated. The company had purchased the property in 2006 for £89,000 and it was valued at £143,000. On 6 April 2016, the annual value of the property is £4,600. The property was furnished by Eco Limited during March 2016 at a cost of £9,400. The living accommodation is not job related. If not job related accommodation is like given to an employee, benefit has to be computed. First, I need to take the annual value, which is 4,600. Then additional benefit has to be computed. For additional purposes, we need to see whether the cost of accommodation is more than 75,000 or not. If it is like more than 75,000, then of course additional benefit will be computed. Considering the cost, I will take either the purchase price of the property or the market value. For that purpose, I need to see that how many years have elapsed. This property was purchased in 2006 and it was given to an employee on 6th of April 2016. So this is how more than 6 years are gone. So we will take market value as the cost. 143,000 is like more than 75,000 pounds. So additional benefit is going to be generated at the rate of 3%. Considering the furniture is also provided, use of asset rule has to be applied by taking 20% of this value. 9,400 being market value of the furniture when first provided to employee into 20%. Third point is on 1st of December 2016, Eco Limited provided Simon with interest-free loan of 84,000, which he used to purchase a holiday cottage. Whenever you are going to get loan for a non-qualifying purpose, you will have to compute benefit on it by taking that how much interest has been saved. 3% would have been paid if in case he had gone to bank in order to get the loan. Currently he is paying nothing because it is an interest-free figure and the loan has been taken for just 4 months. Keep one thing in mind, and on 1st December 2016 loan has been taken up. So December, January, February, March, it's like 4 months and 5 days loan has been taken up. Days should be ignored. I'll be taking benefit for just 4 months. As far as partnership scenario is concerned, the partnership tax adjusted trading profit for the 4-month period ended 30th April 2017 is £29,700. This figure is before taking account of capital allowances. So this is going to be an adjusted profit figure of £29,700. The only item of plant and machinery owned by the partnership is a motor car with a cost of £18,750, and that has been purchased on 1st February 2017. Keep one thing in mind, whenever a business is going to get a plant and machinery, capital allowance rules are to be imposed. It's a car, so no AIA will be possible, and the capital allowance rate, WDA, of 30% is going to be applied because cars' carbon dioxide emission is found to be 155. That's more than 130 grams per kilometer. But we will have to take only the 60% of the capital allowance, because whenever a self-employed person is going to make use of any asset for dual purposes, only business proportion is relevant. Then when the profit is adjusted, remaining profits are distributed in a proportion of 40% to Simon and 60% to R. And keep one thing in mind, that this figure will be distributed when 6,000 salary will have been paid to R, the self-employed person. As far as property income is concerned, Simon owns a freehold house which is let out furnished. The property was let throughout the tax year at a monthly rent of 810. So I will take 810 into 12. A whole year rent has to be taken up on accrual basis. During this year, Simon paid council tax and water rates of 1320. The expenses are going to be deducted against the rental income, and then he spent 2560 on purchasing a new bed for the house, which replaced an old one which was sold for 100. Whenever an asset is replaced, replacement furniture relief is going to be applied. Replacement of £100 is done, so 100 is going to be deducted. Remaining rental income is like going to be taken into your computation. I'm moving towards the last question of this. part, that's NAVE Limited. So the third question is of NAVE Limited. You are a trainee accountant and your manager has asked you to correct a corporation tax which has been prepared by the managing director of NAVE Limited. The corporation tax liability is given for you which contains significant errors. Here is like the corporation tax figure which has been computed over this rule. People, as the time is like almost complete, if you want to, then I can mail you the answer of this question because it's not possible to discuss the question in such limited time period. If in case you want to receive the answer of this question only, I can email you people. If whatever your response is, please write down in the dialog box. Okay, I'll be sending you the mail for the last part of this question. If in case you people have any query, you may please write down in the dialog box. Okay, class, there is like no further question from your side. I'll definitely mail you the last part's answer. It had been a wonderful session with you people. That's all for today. Thank you so much.